How big is a business? It sounds like a pretty simple question, doesn't it? But the deeper you dig, the more you realize the answer is anything but simple. In fact, the way you answer that question can totally change which companies you see as the true giants. So let's dive in and unpack all the different ways to measure a business and see how each one paints a completely different picture. Okay, so let me hit you with this right away. Which company is bigger? Is it the one that sells a handful of super expensive luxury cars, or the one that sells thousands and thousands of affordable everyday cars? What's your gut tell you? Because the answer starts to get really interesting the moment you look at it from a different angle. And here you see the problem, laid out plain as day. On one side, you've got super high value for each thing you sell. On the other, you've got a massive, massive volume of sales. So who's the winner? Well, the truth is, it totally depends on what ruler you're using. There's just no single right answer, and that's what makes this whole thing so fascinating. So to get to the bottom of this, we need to break out our, let's call it a measurement toolkit. We're going to look at 6 common ways to size up a business, and you'll see pretty quickly how each one tells a different story, and why none of them, on their own, are perfect. First up, the one everyone knows, revenue. You know, it's that giant number you see in the headlines, the total cash that comes in the door from sales. It seems simple, right? More sales must mean a bigger company. But as you're about to see, it's not always the full story. Let's jump back to our cars for a sec. Just imagine both the fancy luxury brand and the everyday economy brand sell exactly 1,000 cars. By that logic, they're the same size, yeah? But look at it through the lens of revenue, and that luxury company suddenly looks like an absolute giant in comparison. All right, what about this one? The number of employees. You'd think a company with 10,000 workers is massive compared to one with just 100, right? Well, maybe not. Think about a business that needs tons of people versus a super automated factory that needs tons of expensive machines. That factory could be creating way more value with just a handful of technicians running the show. And that automated factory brings us perfectly to our third tool, capital employed. Basically, this is all about the value of the stuff a company owns, the factories, the delivery trucks, the giant machines. The idea is, the more expensive your assets are, the bigger you are. But you can probably see the problem here. What about companies that don't make physical stuff, like a software company or a consulting firm? Next up is a big one you hear all the time in the financial news, market capitalization, or just market cap. This is just what the stock market thinks a company is worth at any given moment. It's a simple formula. Take the current price of one share and multiply it by all the shares that exist. It's a really powerful way to compare giants, even if they're in totally different industries. But here's the catch. Market cap has some pretty big blind spots. For one, it only works for public companies, the ones on the stock exchange. That leaves out millions of private businesses. Plus, stock prices go up and down like a yo-yo, which can make it a really unstable way to measure a company's actual size from one day to the next. Okay, our fifth tool, market share, is all about context. It's not about how big you are in a vacuum. It's about how big your slice of the pie is compared to everyone else in your industry. It answers the question, yeah, but are you the big fish in your particular pod? And this chart is a perfect example. Just look at the takeaway food market back in 2018. McDonald's had a monster 33.2% share. That's almost double their closest competitor. By this measure, McDonald's isn't just big, it's the undisputed king of the hill. And really, all of this boils down to one key idea, summed up perfectly in this quote. A firm might appear large by one measure, but quite small by another. That's it. That's the fundamental problem we're wrestling with when we try to define what big even means. This table really drives the point home. Let's look at these 3 supermarkets. If you just go by the number of employees, Supermarket Y looks like the winner, with 1,200 people. But wait, slide your eyes over to the revenue column. Supermarket X, with way fewer employees, is actually pulling in the most cash. This just proves how one number can give you a totally misleading picture. So we've talked a lot about how to measure the giants, but let's flip the script. What about the little guys? Small businesses are the lifeblood of most economies, so let's take a minute to look at the underdog's advantage. And man, the difference between a small business and a huge corporation is like night and day. Small businesses can be incredibly nimble, they can adapt on the fly, and offer that personal touch. Large businesses, on the other hand, have layers of management, formal rules. They're just 2 completely different worlds. You know, being a small or medium-sized enterprise, what we call an SME, it's a classic double-edged sword. On one side, you've got amazing control and you can pivot in a heartbeat to meet customer needs. But on the flip side, getting a loan to expand can be a nightmare. And the owner often has to be the CEO, the HR department, and the janitor all at once.
Okay, so this all leads to the next logical question, right? If you're a business, small or large, and you want to get bigger, how in the world do you actually do it? What are the ways to get to that next level?
Well, there are basically two ways to go. You've got organic growth. Think of it like a tree, slowly and steadily growing from its own strength. You're just getting better at what you already do. And then you have inorganic growth. This is the fast lane, growing by buying other companies. So what's the difference? Well, a merger is the friendly version. It's a handshake deal where two companies agree to become one. A takeover, on the other hand, is a bit more aggressive. That's when one company buys up enough of another to take control, whether they like it or not. But, and this is a huge but, this fast-track growth is not all sunshine and rainbows. The goal might be to get bigger, but that journey is absolutely packed with potential landmines. Let's talk about the growing pains. So why do so many of these massive billion-dollar deals just fizzle out? Well, it almost always comes down to people. You get clashing company cultures, one management team that has no idea how the other's industry works, or they just plain fail to work together. That magical synergy everyone was banking on, poof, gone.
And history is just littered with the wreckage of these famous failed mergers. The Daimler-Benz and Chrysler deal was a legendary culture clash. The AOL-Time Warner merger was a spectacular bet against the future that just imploded. And who could forget Microsoft buying Nokia's phone division? Ouch! So the big takeaway here is pretty clear, right? Growing a business isn't just about sticking two companies together like Lego blocks. It's about the messy, complicated, and super difficult job of getting people, cultures, and strategies to actually work together. Get that wrong, and it's game over. And all of this brings us right back to the ultimate question. After looking at how we measure size, the advantages of being small, and the incredible risks of getting big, you really have to ask yourself, is bigger really always better?